price is too low for a bear and not too high for a bull. On that note, welcome to our Zoom web series hosted by One Tree Hill and PMS Cart. This is On the Juggernauts, conversations with uncommon and curious fund managers. Hi everyone, my name is Jai and I have with me today Tejas Gutka, head PMS at Tata Mutual. Welcome Tejas to our show.
Hi Jai, thank you very much. It's a pleasure being here.
Excellent. You know, one of the things that we start off with is what we call the machine gun 15.
Okay.
So sort of a quick fire round to just get our creative juices flowing, hopefully loosen our guards a little bit and just make it fun for both of us.
Sure.
And I tell everyone, hopefully you'll enjoy it as much as I do.
Yes, let's hope so.
Right? Okay, perfect. So if you're ready, I'm good to go.
All right, let's fire.
Okay. So diversification or concentration in equity?
Concentration.
Okay. How would you rate the research on the street from a scale of 1 to 10? 1 being the lowest, 10 being the highest.
So it's too generic. I think I would say about 6.
Okay. Will oil in any future contract go back to 0 or below 0 for that matter?
I have no idea.
But if I had to push you to take a call and give me a yes or no answer?
I don't think so.
You don't think so. Okay. How long do you think India will remain an emerging market?
At least another 10 years.
Another 10 years. Okay. One of the biggest red flags that you see when picking a stock apart from corporate governance?
So for me, the biggest red flag is largely the balance sheet. I mean, the items or cash flow rather.
Okay. Anything specific in the cash flow that you look for?
So there's a very simple measure. You look at how much of the profitability is getting converted into cash flow. If that number is very low, that sort of talks a lot about the quality of the business.
Okay, fair enough. The most difficult question on the street right now and the most interesting, are we at the bottom?
I think we'll know that only once we've crossed the bottom. I don't think there is any way to identify the bottom.
Okay, but if I had to push you for a yes or a no?
I'm sitting on cash, so I'm hoping we're not at the bottom as yet.
Okay, super. Which balance sheet do you think is the most stretched? Is it the government, corporate, or the individual?
It's not the individual for sure. I wouldn't say it's the corporate as well. So I think largely it's the government.
Okay. Would you do a top-down or a bottom-up approach?
No, I prefer top-down, completely top-down.
Perfect. A lot of the themes that are playing up, and because of COVID, it is forcing us to do a lot of things differently. Do you think ESG as a theme will pick up in India? Social and governance thing?
Yeah, I don't think so.
Okay, fair enough.
Given the way we speak good everywhere, I don't think we're getting to ESG very soon.
Okay, fair enough. One aspect that not a lot of people know about you?
I'm an introvert.
Okay. You'll be surprised as to how many fund managers say that.
Oh, really?
This conversation. So. Excellent. Would you double down or double up?
Double up.
Double up. Okay. Are you an optimist, pessimist, or a realist?
I'd say optimist. It's an occupational hazard.
Okay. Excellent. And talking more about the recent events, what has happened with our debt mutual funds, do you think that will snowball into something good, bad, or ugly?
Well, eventually something good, because I mean, every time we've had a problem, we kind of develop something that a way to avoid it. There are obviously unintended consequences to those things which will lead to a new problem. But I mean, largely look at our progress, right? We've been doing more good than bad over the years. So I think good.
Okay, fair enough. And this is what we like to sort of end it with. One thing that investors keep getting wrong across decades, or a misconception that investors have about the markets.
So top of the mind, I have this thing because it's amongst the most discussed things right now, and which is, what is the sector that is going to lead the next rally? And, we've never got this right historically. And so look at it, right? Post 2001, when the Twin Towers collapsed, everyone said that, air travel is gone, airlines are a goner, no one's going to do air travel. And the next 20 years, we've seen the biggest boom in travel across the world, and especially in the emerging world, right?
Sure.
Post 2008, we said banks are gone and infra is the sector to play. And what played out was the complete opposite, right? Banks was the best sector to be in, and infra was probably the worst to be in. So I think this is an exercise that we've been doing for so long, and we get it completely wrong.
Okay, so would you actually suggest to be a contrarian in a market like this, or trend following?
Okay, look, see, contrarian, don't be a contrarian for the heck of it. Like, a lot of times contrarian is being, so for example, growth is a big theme that's played out in the last 10 years.
Sure.
Don't get into value traps just because you want to be a contrarian. You could be a contrarian being within growth as well, saying, where is growth not properly priced in. So I'd say be a contrarian, but bear in mind that the quality of the business is very, very important. Don't invest basis valuations alone.
Okay. And one last question to end this: how many times do you think you are right in the market?
Oh, I would say, I don't know. I'd say it's about 50-50. Yeah, it's as good as a monkey right now.
Sure. Fair enough. Great answers, Tejas.
Thank you.
I'm happy to announce that your coffee with Karan hamper should be reaching you at your house as soon as this lockdown ends. So congratulations.
Thank you.
But on the lockdown, where do you see the lockdown going for cities like Bombay, Delhi, etc., and also for maybe the tier 2 towns or tier 2 cities?
Right. So my sense is overall the lockdown is going to probably last a little longer than what we'd imagine. I think today already there were indications that this is going beyond the 3rd of May. And I would expect that it would go beyond 3rd of May, because while we are trying to flatten the curve, you want to see the numbers go down drastically before you sort of release the lockdown, because we are a very populous country, and especially cities like you mentioned, right? Our cities are so densely populated that second wave can be very, very dangerous. And see, the good thing for us is we have precedents, right? We know that Singapore, what happened in Singapore, Korea, once the lockdown was sort of eased, and how the second wave came through. So I think to that extent, we're going to be a little more cautious. I think thankfully we started on a very, very cautious note. We took the most dramatic step that we could take given the information we had then. And I think that's paying off very well for us. And I think we'll sort of we'll continue to be conservative.
Okay, sure. Excellent. Moving on to sort of yourself, a lot of our audience, wants to sort of connect to the fund manager, right?
Okay.
And one of the reasons, or one of the things that helps us connect them to you, is to understand, what was your first sort of interaction with the stock market? Was it a complete random event that, you're standing at, outside the BSE looking at the tickers and said that, look, let me get in and, check what this is? Or was it a more well thought out plan?
So it was not a very well thought out plan. I'll tell you, this largely happened while I was graduating, and a little directionless at that time. I didn't know where life was going. I largely followed interest. I was pretty good with maths, computer science, and so on and so forth. So I was trying to pursue computer science, and I've been a science student up until graduation. So I was trying to pursue that, and at some point started reading the newspapers, and I read about this gentleman called Warren Buffett and how he was helping people create wealth, and that idea resonated so much that at that time I had no idea about how finance works or what stock investing is and so on and so forth. But that idea just sort of hit me, and I kept thinking about it, and I spoke to a few friends. Luckily, they were from the commerce background, and some of them said that an MBA is the way to go there, and so that's where it all started. I in fact took a year's break post graduation to kind of figure things out as to what's happening, what is MBA, and there used to be a text in the locally Indians, the biggest text that you could read for finance was a textbook by Prasanna Chandra. Okay. I forget the name of the book, but it is like a pretty thick text on finance. And if you were graduating in finance, you need to have read that text. So I took a year's break. I went through such text and kind of tried to figure out, quite naively tried to sort of build a link between maths and finance, which now you realize there is none. But but yeah, I mean that's how. I mean it was largely an accident. I mean it was a lucky break, to be honest.
Okay, very interesting. You're obviously now with Tata Mutual, and so, a lot of their schemes in the PMS have done well, right?
Right.
What would you attribute as being sort of the edge or the process or the USP per se, for this success?
So two things come to mind. First and foremost is a very, very, very long horizon. We've been in the PMS business for a very long time, and if you see some of our top holdings, they've been in the portfolios for as long as we've been in the business, or a little shorter. But about 7-8 years holdings is what I've noticed in a lot of portfolios.
Sure.
And when you have the ability to ride a business for 7-8 years, you know what kind of rewards you make, right? There's something in the portfolio that was probably, when it was bought, it was about 2.5% of the portfolio initially. When by the time I came in, it was about 8-9% of the portfolio. So you can imagine the kind of outperformance that some of these businesses can sort of generate. So that's the first thing. The second thing was, obviously, there was a lot of focus on what went into the portfolio. So if you look at and we've had about 4-5 of us who managed the PMS over the last 10 years, right? But if you look at the quality of the portfolio, it's very, very good. Like, you only find top quality businesses in the portfolio. There's no hunky-dory business happening there. So I think a combination of these two, and which is largely what Warren Buffett, Charlie Munger, Phil Fisher teach us, that
Right.
Good quality businesses, long-term outlook, and sort of sit tight. I think that's worked really, really well for Tata.
Very interesting. If I had to probe a little bit more on a few things that you said,
Sure.
you said that quality businesses is what you all sort of look to get into.
Right.
But
Right.
you could elaborate a bit more, because quality has taken very different sort of
Right.
connotations, and especially in a market which is very volatile,
True.
right? So is it quality from a quarter to quarter? Is it quality which is much longer per se? How do you define quality?
So you're right. There's been a pretty big evolution in quality. I mean, in fact, personally for me also, right? Because when you start up, when you come out fresh from an MBA school, you've learned a lot of ratios, and so you're kind of looking for answers in only those ratios that the liquidity ratios and the debt equity ratios and the ROCs and the ROEs of the world.
Right.
And for a pretty long time, that's where I thought quality remained. ROCs, ROEs, and so on and so forth. But over a period of time, you realize that like I said initially, that quality is essentially. I mean, look, what is the essence of a business, right? You have a certain skill which you're providing to the world. To provide that skill, you invest a certain capital in the business. You're expecting to generate an above average return on that capital, right? That's largely what you're trying to do in a business, be it a service or a manufacturing or a bank or whatever, right?
Sure.
One metric that reflects this ROC so well is cash flows, right? It sort of tells you how efficient your business is. So everything gets captured in a cash flow. It's a single metric that'll tell you about profitability, that'll tell you about the quality of the balance sheet, and so on and so forth. I think over the years, I have come to appreciate cash flow a lot, and that's largely where I like to start looking at businesses now. It's no more what is the growth or what is the ROC. You kind of first tend to look at okay, what do the cash flows look like, and then work your way backwards as to why it's so good or why it's not that great.
Got it. And one of you mentioned that when you guys enter into a business, is generally for a much longer time frame. But if I had to ask you, what has been sort of the and if you have an answer right now for me, what has been the sort of the shortest holding period in your portfolio over the years?
Okay, so I'll talk about portfolios that I have looked at in the past, and rather not.
Absolutely, in your experience.
Yeah. So the shortest that I think I have held on to is about a year and a half.
Okay.
Basically, bought a business, looked very, very interesting, had pretty good numbers, pretty good specs. But there was a macro element to the story, and you realize over a year and a half that the execution is not happening. It's probably a mistake, and then you sort of get out of it.
Sure. Okay. Interesting. Sort of carrying on for that, the reason I asked is that more often than not, clients, figure out an entry point quite easily.
That's
right?
true.
Whether it's for a product, whether it's for a stock, whether it's an overall view.
Right.
But very limited knowledge or inferences when it comes to exit.
Right. That's true.
Right. So would you be able to throw some light for our audience in terms of, what are some of the good exit strategies, or what should I be looking for, when I want to exit a product or exit a stock person?
Right. So, one of the first books that I ever read on investing was Common Stocks, Uncommon Profits by Philip Fisher, and largely that's something that I've been trying to practice over the years, right? And it's, I think, probably one of the few books that talks about these things that when you look at a business while you're looking for the long term, there are a few parameters that you should look at when you bought a stock
Right.
to figure whether you're wrong or not, and therefore whether should you exit or not. And I think it largely boils down to two or three things, right? Look, typically we buy businesses for, let's say, a 5-year horizon, and if you bought something and it trades at a valuation where maybe you're discounting more than 5-7 years, I have used that as an exit strategy, and it has worked because stocks never go up linearly. There is volatility, and you will get a better entry point, or the price may just stagnate there for years, and therefore at some point the valuation sort of
Sure.
but that's very sort of that's very valuation driven, and a pretty arguable point, to be honest. But look at fundamentally, right? What are your triggers? You expected the business to have a certain trajectory, and it doesn't. And in most cases, it won't follow the trajectory that you expect. But if you understand where the divergences are coming from, I think that helps you figure whether the problem is internal to the business or external. If it's an external problem, I would like to wait, and maybe give it the business a little more time before I decide whether I've made a mistake or not. If it's an internal problem, you're largely sort of looking to exit immediately. And other than that, I think another important thing is when you realize that they are trying to make some investments which are unrelated, or at a time when the balance sheet doesn't allow them to. I think those are two other triggers that I look at and say, okay, maybe great business, but right now let's exit.
Sure. No, that's a very interesting take on it.
Right.
And sort of taking the absolute opposite view of that. If you could highlight one sort of opportunity that was very obvious to you, personally, but sort of the market did not see it across your time horizon of your experience.
I don't think market has not seen it, because then it's not an opportunity I want to talk about, because
Okay.
the stock that's not done anything. But on a more serious note, I think a couple of so I'll tell you a silly mistake that I made. I saw the opportunity, and I got carried away. This is, I think, about 2011 or 2012, and I used to run these screeners as an analyst there then. And I used to run these screeners and look at companies, and I had sort of three other companies that had come across pretty well on those screeners. One was Astral Poly, one was Serra Sanitary Ware, and one was Swaraj Engines. Largely, all three have done pretty well. Swaraj, obviously, being a cyclical sort of a business, hasn't done as well as maybe Astral or Serra has done. But what's peculiar about Astral is, I like the story. I read about it. I spoke to the management. I was completely convinced. And then I got to know that, there is a lot of a lot of demand. A lot of people are trying to buy the stock, and the stock is not available. And that's why it's run up a little. And I said, okay, let's wait a little for it to come off, and then we'll buy. And that opportunity has never come back. So you identify a good business, and Astral that time was very, very small, right? I mean, the size was hardly anything.
Right.
The market cap was, I think, in a few hundred crores. If you find a business of that size, I don't think you should wait for a great entry price. Maybe you should stagger your purchase, or sort of buy a small quantity and hope to average down or average up, but always enter. I mean, that's one of the bigger lessons that I've learned.
Okay, fair enough. And sort of taking that to another extension, the next question is one of my favorite questions. When I started off way back in 2004, I probably lost close to 6-7 months of my salary getting into some leverage commodity play.
Right.
Getting, very greedy, obviously.
Right.
Is there a significant tuition fee that you've paid in your career where, you've lost a sizable portion of, salary or wealth and have learned significantly since then?
Oh yes, absolutely. I think largely all of us have done that. When we started off, we had no idea as to how to sort of invest. Most of us were worse than traders, but all of us thought we are very intelligent, and so let's do this.
Right.
I mean, initially I was pretty similar, and I in fact started off as a credit analyst and then moved to equities, right? So when I started, I had no access to the markets. largely through some friends, I used to get access to some broker reports, and I just read them and say, oh, he's looking at a 20-30% upside. This is fantastic. Let's buy this business. Not bothering to understand the business at all, and in fact lost a lot of money. So this is about 2007-8, right? A lot of friends would call up and say, buy this, buy that, and everything went up. And you kept resisting for you resist for a month, 2 months, 3 months, 6 months, and then eventually you realize, okay, look, this guy is going right always. Okay, let me follow him. And the moment you buy it, the market crashes. It was just waiting for you to buy it. So yeah, I mean, I've gone through all those mistakes, and we've as a family also learned the hazards of leverage. My father used to have a broking business back in the days, and we just offered him a line of credit, and he took it. And this was the days when he wouldn't check his emails, and a lot of margin calls would come on email, and he would not realize. And suddenly he realized half his portfolio is sort of gone.
Sure.
So yeah, I mean, we've had those lessons in the family, all of us, and it's good to have those lessons early, right? Because you have so little capital, and if you learn those mistakes early on, then with larger capitals, you're way more careful.
No, absolutely. And one of my client tells me, and I still don't know whether he's serious or joking about it. He's saying that I generally don't hire a fund manager or advisor because they have a magic wand, or I think they have a magic wand. It's probably for the 12-15 years of mistakes that they come with, and hopefully they won't repeat them on my portfolio. Right? But very interesting take. Sort of taking on to the difference between sort of mutual funds and PMSs.
Okay.
We've seen a lot of spreads, a lot of AUM move from mutual funds to PMSs, right? Okay. We've seen that one reason obviously there's been a push from the distributor community onto PMSs, right? But I want to address something a bit different, in where there has been enough move saying that, look, a mutual fund is heading towards a closet index fund, or most mutual funds are heading towards closet index funds.
Right.
And now as a fund house, obviously Tata has mutual funds, has PMSs per se. But do you agree that saying that at some level, the alpha in mutual funds is coming down, and that is sort of getting transferred to PMSs because they can do a lot more slice and dice?
So look, both have their own advantages, right? PMS unfortunately has we've had a pretty bad journey, so to say. And look at the history of PMSs, right? Pre 2008, PMS was largely a satta vehicle. You sort of gave 2 or 5 lakh rupees to your broker. He did something. You were expecting a rocket to come out, and largely that rocket fizzled on the ground, and you got back nothing.
Right.
Then you had the first wave of regulations. And then you had the first wave of industry formalizing, and the larger ones. That's when the larger ones actually started getting recognition, and they got sort of pretty large. That's where ASKs, Motis of the world sort of became very famous, and that's where they are sort of the journey of over 1,000 crore of AUMs and so on and so forth. Those things started. Right. Then you had a second round where post 2013-14, a lot of professionals sort of moved out of their corporate jobs and started their own outfits. But then 2018 happened, where largely everyone thought small caps is the space to be, because that's the only way you can differentiate a PMS from a mutual fund through small cap investing. And that's what everyone did, and you kind of realize that, okay, there is a lot of risk in small cap investing also, and obviously there was a lot of mis-selling that happened, upfronting and so on and so forth. Sure. So you had the second round of regulations that come in. So I think PMS has had its own journey, and if you look at the guys who've done it right, who've gone larger, most of these guys were not sort of kings of small caps or mid caps. They've actually done it in fairly multi-capish portfolios. So sure. So I think the right way to look at it is that what PMS offers you is an ability to concentrate. There are a lot of studies that say that your top 10-15 stocks is largely what contributes to your overall return. The rest of the tail actually just takes away your return. MFs, I think, largely because of their size, have to be in 20, 30, 40 stocks, right? And then your weights start going down as you look at 40 stocks. In a 20 stocks, you tend to allocate more to a business. So your failures and winners tend to get magnified to that extent. Right. And I think that's where a lot of alpha has come from. So guys who realize that, look, failures can get magnified, therefore let's avoid the failures. And if you just avoided the failures, by virtue of not having failures, you did so much better than the rest of the world, right?
Right.
And I think that is what a PMS really is. It can offer you a fairly concentrated portfolio,
Sure.
but need not necessarily be mid or small cap. Obviously, I think small cap is a space that PMS can make a lot of difference to, because it's a space for MFs. At some point, it will get sort of inaccessible because of their own sizes.
Sure.
And PMS, given that most of us are customized portfolios, and you could build a 300, 500,000 crore small cap PMS
Right.
with about 15, 20 stocks. So I think eventually, yes, we'll get there. But I don't think that is what has gotten us here so far.
Okay. Okay.
Yeah.
Fair enough. And you also obviously mentioned alpha. While everyone is, and one of the topics that comes up now, and significantly so, is diversification. Right.
Right.
For the longest time, alpha has always been associated with equity per se. Right.
Right.
Where do you see, if anywhere else, another source of alpha for investors? From a different asset class, more likely than anything else.
So look, I tend to guide it towards a pretty simple philosophy of having a set asset allocation and keep rebalancing at a certain time interval, right? And look at the simplest sort of portfolio that you could build. Is a 60-40 kind of a portfolio, right? 60 debt, 40 equity, or 60 equity, 40 debt, depending on your risk profile. And let's say you were 60 debt, 40 equity, and you were in 2013, right? 2013 was a bad year for equities, so the weight of equities fell, right? Which means at the end of the year, if you were rebalancing, you would have taken money out of debt and put it into equities.
Right.
Then the entire 2014 rally, right? Which means in 14 and 15, you were largely selling equities, putting money into debt, right? And then 16, you saw 15, 16, you saw a fall in markets. First two, 3 months because of China currency depreciation, and towards the end of the year because of demon, which means that was a year that you probably have added to equities. Again, 17 was a great year, which means that was a year you would have sold equities. This automated process makes the whole thing so simple. It's very counterintuitive. Doesn't require any sort of behavioral psychology theory or nothing. It's simple.
Okay.
Buy a 60-40 portfolio based on your risk appetite, either 60 equity or 40 equity, and rebalance, let's say quarterly, 6 monthly, or yearly, sort of whatever you're comfortable with. But this automated system, will ensure that you will outperform at least 70 to 80% of other investors who try to sort of time things by chasing returns.
Sure. So I'll take it that you're not a big fan of timing per se.
No, not really. I mean, look, none of us get this right. I think largely the way I do, and if you look at my personal allocations, right, largely the way I do it is that in environments like this is when I try to push a lot into equities. In other environments, I'll try to push to a lot to liquid fund. I am not too much of a I don't have a lot of allocation to debt. Given that I think at my age doesn't make sense. As I get older, I'll start allocating to debt. But that's how I do it. When you don't find out, I have some allocation to gold that I've been sitting on for some time. So
right.
So that's how I like to play it. I mean, look at generally if everyone's very euphoric, you're getting a lot of flows. Maybe it's time to sort of slow down on incremental investments.
Okay, fair enough. And also, from an investor point of view, a lot of questions have come up saying that, look, I understand that there are PMSs and mutual funds, but why not also give them the option to be able to hedge, to lever, to trade in options, to maybe where they can sort of incrementally either save some money during the sideways or a bear market,
right?
Because it's sort of concentrated per se. And then give them that optionality, or at a minimum give the optionality even to mutual funds to sort of have a significant portion in cash, right? Because most mutual funds per se have very little amount in cash. That might change with what we've seen in terms of regulations. But till it does, why aren't more mutual funds or more PMSs playing around with cash or options or in terms of hedging their portfolio?
So let's start with the biggest, right? And you largely know that it's really difficult to sort of make an elephant turn very easily, and that proverbial elephant is what mutual funds are, right? With the kind of portfolio sizes that you sit with, it's very difficult to get in and out of stocks. without impacting prices, right? So for MFs to take a lot of cash calls is very difficult.
Sure.
Largely from whatever little I know, I think what people do is when you get a lot of flows, they may be a little slow in deploying, and that is how you see cash in the portfolios. But I don't think a lot of buying selling is easy to do in a country like India, where you could easily get in, get out of even large caps without impacting the prices. So I don't think MFs can really do that, and therefore I think. See, largely the way I look at it is, I think allocation is either in the hands of the investor or the advisor. Don't let the fund manager do the allocation, because sometimes it may just magnify the whole thing. As an investor, if I have taken a cash call, which means I'm not putting incremental allocation to equities, and my fund manager is also doing that, then the two of us are taking a cash call, and it may turn out to be a very large cash call, right? So therefore, I believe that allocation should be left to either the investor or his advisor. The fund manager has a mandate of buying equities, and let him do that, and let him not sort of take cash calls. Coming to hedging and options, look, these are dangerous sort of instruments if not understood well, and trust me, most of us don't understand it that well.
Sure.
I have seen this live where I saw someone taking a hedge position in 2008-9. And it takes years to recover that one mistake. Leverage is can be devastating. I don't think it adds as much to returns as it usually takes away. And therefore, I am personally very scared of leverage. I am happy that regulations don't allow us to leverage. So by through no one am I being forced to sort of take some leverage. I think it's extremely just very misunderstood. I've in fact worked on the debt side also for a fair bit of my career, and a lot of especially international investors, and now a lot of family offices in our country take a lot of leverage to sort of invest in debt, right? Because otherwise the coupon doesn't make sense. So to take your duration calls, you sort of leverage, and then you play a 25, 30, 50 bip sort of rate cut. And I've seen that again. You get a 50 bip rate cut right, you will make 10-15%. You get it wrong, you lose 20%. Right, so the risk rewards are not really in your favor. It's probably helpful for someone who's very jittery, who gets scared very easily, and therefore will cut his losses immediately. At the first downtick, he'll say, "Okay, let me get out of here." For most of us who are sort of tuned to be long term, and say, every fall is an opportunity to buy. I think we will sort of create doom for everyone if we leverage.
Okay. So, I have to say a few things out here. I managed a long short fund for close to 2 years,
right?
At Edelweiss, and obviously we leveraged in a manner where we thought at least it wasn't dangerous or risky.
Right.
We came out okay. So I think there's probably a middle path with what you're saying, what the regulation should do.
Right.
But completely appreciate the point that I think it should be separated for sure. And someone who's investing in a product which is allowed to lever in a way should understand those risks completely.
No, I mean, that's my point, right? See, leverage requires a different mindset. Don't bring in leverage into every product, right? You have to have a separate mindset to do leverage products, and which is where I think I don't think you should get it into the current structures. I think largely it remains in AIFs, and which is where I think it belongs to, because A, your investor is that much more sophisticated, and B, you have a manager who's also sort of pretty good at that.
Absolutely. Great, Tejas. So we are almost coming to the end of this conversation, right? One of the questions that a lot of people who just started taking money, who sort of becoming fund managers, they started taking their friends and family money, external money in some sort of setup, whether it's a PMS, managed account, etc. A lot of them have just started, seeing the markets where they are.
Right.
A lot of them have started in the last 2 quarters, and I've seen quite a bit of, blood on their books, right?
Right.
You've been around for a significant amount of time. What would you be telling these people right now?
So look, when we think of the future, or when we look ahead, we kind of look at a funnel, okay? And if this was the funnel, right? This is your time horizon. This is the near term. It looks very big. The long term looks like the smaller end of the funnel, right? So when you're going through some problem, it looks like, oh, it's a very big problem, and the gains that you're going to get out of the problem is so small because it's so far away,
Right.
but trust me, it's always the other way around. You will look back at this and you will say, "Boss, if I had invested into this at any level, I would have
Sure.
made good returns." And this is something that I've written about a lot about in the past, and I keep telling investors that if you made two portfolios in 2008 and 2009, the portfolio that you made in 2008 was at the peak of the market, and you only bought businesses where you said my only filter is, let's say, high ROCE. So I build a Nifty portfolio where I buy the part of Nifty which is high ROCEs irrespective of valuations. 2009 at the bottom, I buy the most loved stocks of the market, right? So 2008 portfolio was Pidilite, Asian Paints, Bajaj Auto, and
Sure.
few such names. The bottom part was largely infra, right?
Right.
And you held it through everything that you've gone through. The portfolio that you built at the bottom has not only underperformed the market, it's actually not made you any money. And the
Sure.
portfolio that you bought at the top of the market has not only made you money, it's outperformed the market. So that's the beauty of sort of knowing where to invest rather than knowing when to invest. So don't
Sure.
worry about the reds in the books. All of us are sitting with them. But like I said, investing requires you to have a certain amount of optimism. So
Sure.
hold on to that optimism. It will eventually be all right. And as long as you invest in the right kind of businesses, you will look back at this and say, "Oh, I should have invested more."
Okay, fair enough, Tejas. Thank you so much for your time. Is there something that you would like to add?
No, I mean, this was fun. I mean, this was pretty good. I didn't realize where the time flew by, and I'm sort of looking forward to do more of this in the future.
Super, super. Hopefully, our series, carries on to sort of season 2 as well.
Yes,
But again, Tejas, thank you so much to you and to Tata Mutual for coming on this series. Here's wishing you a really good 2020 to you and your team, and hoping everyone and at your place and your workplace is safe.
Thank you so much for having us, Jay, here, and wish you and your family and your teams a lot of safety through this environment.
Perfect. Thank you so much for this, Tejas.
Thanks, Jay.